Ever wondered how the financials of tech giants like Dell and IBM compare? Well, you're not alone. In today's discussion, we will be pitting Dell against IBM, comparing their financial performance based on a number of key parameters. We will be looking at their revenues and how they have evolved over the years, examining the structure of these revenues, and analyzing their profitability through gross and net profit margins. Assets are the lifeblood of a company, so we'll also be delving into the total assets held by each of these companies and how they've changed over time. But it's not just about the assets they have, it's also about how effectively they can be turned into cash if the need arises. Hence, we'll be looking at some key liquidity ratios as well. Operational efficiency is another crucial aspect that can make or break a company. So we will be scrutinizing the inventory and accounts receivable days for both Dell and IBM. And since cash is king, we'll be evaluating the cash flow generated by their operating activities. Finally, we'll be assessing the return on equity for both companies. This is a key metric that can provide a snapshot of a company's profitability relative to the equity invested in it. So, buckle up as we delve into the numbers and see what they tell us about these two tech powerhouses. A scene script. First, let's look at how much money these companies are making and where it's coming from. Starting off with Dell, their total revenues for the first 3 quarters of 2023 stood at $66 billion. Not too shabby, right? However, if we rewind the clock and look at their performance over the past 5 years, we see a compound annual growth rate, or CAGR, of negative 0.2%, indicating a slight decrease in revenues. On the IBM side of things, they reported total revenues of $45 billion for the same period in 2023. But similar to Dell, IBM's revenues have also been on a downward trend with a 5-year CAGR of negative 5%. So, where's all this revenue coming from? For Dell, nearly half, 46%, is generated from their commercial client division. Servers and networking contribute 19%, while storage chips in with 18%. The remaining 17% is split between consumer client and others. IBM, on the other hand, relies heavily on its software division, which accounts for 42% of its total revenue. Consulting isn't far behind, contributing 34%, while infrastructure and others make up the remaining 24%. But of course, revenue is just one part of the story. It's essential to understand how much of these revenues are being turned into profits. After all, a company can have high revenues but still be unprofitable if its costs are too high. In the case of Dell, their gross profit margin for the first 3 quarters of 2023 was 23%, slightly lower than their 5-year average of 27%. IBM, however, boasted a gross profit margin of 54%, surpassing their 5-year average of 49%. When it comes to net profit margin, Dell stands at 3%, consistent with their 5-year average. IBM, with a net profit margin of 9%, has managed to slightly improve upon their 5-year average of 7%. Next, we'll take a look at how much of this revenue is actually turning into profit. Now let's move on to the profitability of these companies. In the realm of profitability, gross profit margin and net profit margin are 2 critical indicators. Let's start with Dell. In the first 3 quarters of 2023, Dell's gross profit margin stood at 23%, a dip from the 5-year average of 27%. The net profit margin, however, remained stable at 3%. Consistent with the 5-year average. On the other side, IBM's gross profit margin for the same period in 2023 was a whopping 54%, surpassing the 5-year average of 49%. IBM's net profit margin was also on the rise, reaching 9%, a 2% increase from the 5-year average of 7%. These numbers only tell half the story though. The net profit figures reveal more about the bottom line. Dell's net profit for the first 3 quarters of 2023 was $2.1 billion, a significant turnaround from the negative $2 billion in 2018. In contrast, IBM's net profit fell from $6.8 billion in 2018 to $4.2 billion in 2023. In essence, while Dell has been successful in flipping its net profit from negative to positive, IBM, despite a higher gross profit margin, has seen a decrease in net profit over the past 5 years. This divergence in net profit trajectories underscores the different paths the two tech giants are on, with Dell seemingly making strides in profitability, and IBM facing challenges. These figures also remind us that while margins are important, they are just part of the profitability picture. The final net profit, which takes into account all expenses, taxes, and other factors, is the true test of a company's profitability. Now that we've looked at profitability, let's turn our attention to the assets of these companies. So, how well are these companies managing their assets and their liquidity? When we glance at the balance sheets of both Dell and IBM, we can note some distinct differences. By the end of the third quarter of 2023, Dell's total assets were $83 billion, while IBM's total assets stood at a whopping $129 billion. However, the net assets tell a different tale. Dell's net assets were in the negative, at minus $3 billion, while IBM's net assets were in the positive, at $23 billion. Moving on to liquidity, which is a measure of a company's ability to meet its short-term obligations, we find some more contrasts. The current ratio, which compares a company's current assets to its current liabilities, was 0.76 for Dell, and 0.91 for IBM. This indicates that IBM has a slightly better ability to pay off its short-term liabilities with its short-term assets. Now let's consider the quick ratio. Unlike the current ratio, the quick ratio subtracts inventories from current assets before making the comparison with current liabilities. This gives us a more stringent measure of liquidity. Dell's quick ratio was 0.69 while IBM's was 0.86, indicating that without relying on the sale of inventory, IBM has a better chance of meeting its short-term obligations. So, when we look at these figures, IBM appears to have a better handle on managing its assets and liquidity. However, it's important to remember that these are just numbers. They can give us a snapshot of a company's financial health, but they cannot tell the whole story. Next, we'll look at how efficiently these companies are operating. Efficiency is key in business. So, how efficient are Dell and IBM? Both companies have a tight grip on their operations. Dell turns over its inventory in 22 days, while IBM accomplishes this in just 19 days. When it comes to collecting payments, Dell takes 45 days and IBM takes 36. Now let's consider cash flow. Dell's operating cash flow stands at $7.1 billion, and its free cash flow is $5.1 billion. IBM, on the other hand, has an operating cash flow of $9.5 billion and a free cash flow of $8.5 billion. The ratio of operating cash flow to net income is a telling figure. Dell's ratio is 3.4, showing a healthy cash generation from its operations compared to its net income. IBM's ratio is slightly lower at 2.3 but still indicates a strong cash flow. Finally, let's look at the return on equity. The return on equity can tell us a lot about a company's profitability. So, what does it tell us about Dell and IBM? The return on equity, or ROE, is a measure of a company's profitability that reveals how much profit a company generates with the money shareholders have invested. In the case of Dell, their ROE in the third quarter of 2023 was negative 106%. This was due to their net profit margin of 3%, asset turnover of 1.02, and the negative asset-to-equity ratio of negative 32.4. On the other hand, IBM's ROE was 24%, with a net profit margin of 9%, asset turnover of 0.46, and equity to total assets of 5.58. And there you have it, a comprehensive data-driven comparison of Dell and IBM's financials. Don't forget to subscribe to the channel to receive the latest videos. Please comment on the businesses you want us to analyze and we will cover them in the upcoming videos.